Hey everyone, welcome back to Corporate Decoder. We usually dive into big companies, but today we're looking at a bank that has some interesting financial moves to share. Today we're breaking down the latest report from the Federal Home Loan Bank of Cincinnati FHLB to see what is really going on beyond the fancy financial terms. Before we dive in, if you like getting straightforward insights from corporate filings, make sure you're subscribed. We also have a Discord community linked in the description below where we break down more documents like this. So, what is the big deal with this filing? Well, the Federal Home Loan Bank of Cincinnati, or FHLB as we all call them, is explaining how they get their money. They get most of their funds by selling debt. This debt is called consolidated obligations. Think of it like borrowing money from the public to lend out. These debts are shared obligations, meaning all 11 federal home loan banks are on the hook for them. They resold through something called the Office of Finance. It is important to know these are backed by the resources of all the banks, not guaranteed by the US government. Now, the really interesting part is Schedule A, which lists the specific debt they're committing to issue. This tells us about upcoming borrowing plans, and it is crucial for understanding their financial strategy. They're not including short-term debt here, only longer-term bonds. It is like looking at their long-term financial commitments. Let's look at some of the numbers here. We see a few different issuances happening around mid-October 2025. For example, there is a bond with a trade date of the 10th of October 2025, a settlement date of the 14th of October 2025, and a maturity date of the 15th of June 2026. This one is for $50 million. Then on the same trade date, there is a much larger issuance for $750 million, also maturing in May of 2026. They've also got a $900 million bond with a maturity in June 2026. This shows they are actively managing their funding needs with substantial debt issuances. Interestingly, not all of these are simple loans. We see some with optional principal redemption, which means the bank can choose to pay back the money early. This is a way for them to manage interest rate risk. If rates go down, they can refinance at a better rate. Some of these are Bermudan call style, meaning they can call them back on specific dates. There is also a bond with a coupon rate of 4.000% maturing in October 2028 for $15 million, and another one for $250 million at 3.795%, maturing in November 2026. These details show they are using a variety of strategies to secure funding and manage their financial obligations. They're issuing what are called variable single index floater bonds. What that means is the interest rate on these bonds isn't fixed. It changes based on certain market indexes. It's like a tracker rate for their borrowing costs. This allows them to benefit if interest rates fall, but it also means their interest costs could rise if rates go up. This is a common practice for banks to try and match their borrowing costs with their lending income. And finally, signing off on this report is Alison Dekeft, holding the title of First Vice President, Assistant Controller. Now, looking at this report, the Federal Home Loan Bank of Cincinnati is very active in the capital markets, issuing substantial amounts of debt. On one hand, this shows they are a robust institution capable of securing significant funding, which is essential for their operations. The use of variable rate instruments like the variable single index floater bonds suggests a strategy to manage interest rate fluctuations, a constant battle for financial institutions. However, all this borrowing comes with inherent risks. While they are managing interest rates, economic downturns or rapid interest rate hikes could still strain their resources. The report doesn't explicitly detail the associated risks of these issuances beyond the general description of consolidated obligations, which are jointly and severally liable among the 11 FHL banks, meaning if one bank falters, others might have to step in. Overall, the Federal Home Loan Bank of Cincinnati appears to be strategically managing its funding through diverse debt instruments. The sheer volume of issuances points to a healthy demand for their debt, indicating confidence from investors. The key for them moving forward will be how effectively they manage the interest rate exposure and the overall economic climate that could impact the 11 banks collectively. Alright, that is our breakdown of the Federal Home Loan Bank of Cincinnati's latest filing. What is your take on these numbers and what they signal for the company as future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description below. Thanks for watching. See you next time.